Hello everyone. Today I'm going to talk a little bit about liabilities. So liabilities are debts that are owed to creditors, and they have three main characteristics. They will occur as the result of a past transaction or event. They create a present obligation for future payments of cash or services, and that's important to distinguish that it's cash or services. It can be the promise to provide a service at a later date. And they are also an unavoidable obligation. The obligation must be met. Current liabilities must be paid with either cash or with goods and services within 1 year or within the entity's operating cycle. So 1 year or less, it would be considered current. Long-term liabilities do not need to be paid within 1 year or within the entity's operating cycle. So they're just longer term in nature. So some examples of current liabilities. Accounts payable is a current liabilities. These are typically due in 30 days or less. And these are amounts that are owed for products or services. They're on account, or basically they've been charged or not paid for with cash yet. Okay, and this is accounts payable. They're typically due within 30 days or less. Another distinguishing factor of accounts payable is that they do not typically require an interest payment. Okay, that's a distinguishing factor. If interest is included, it's usually going to be a note payable because it's going to be longer than 30 days. Sales tax payable, most states will assess sales tax. I think they all do. I don't know of any that doesn't collect sales tax. Retailers collect the sales tax in addition to what they charged for the item that they sold. And sales tax payable is a current liability because the retailer has to remit the sales tax to the state in less than a year. Usually there are some rules about that. It depends, I think, on how much business you do and probably the state you're in. But I think most businesses probably do it every 30 days. And a lot of students will confuse sales tax payable as an expense. It is not. It is a liability. It is something that you must pay to the state. And then unearned revenue. Unearned revenue, we also call this deferred revenue. And this comes in play when a business gets cash in advance of providing the goods or performing the service. And so they have an obligation to provide goods or services to customers in the future. So, think about it this way. If you were to say, pay someone to cut your grass in the summer, and you pay them for June, July, and August, and you pay them on June 1st for all 3 months, you expect that in July they're going to come back and cut your grass, and in August they owe you to cut your grass, okay? So you've paid in advance, and you're expecting to get something in the future, okay? So this happens all the time with businesses. Another example would be an airline ticket. When you buy your airline ticket, that airline does not record the revenue right then. They record unearned revenue. When you actually use the ticket and take the flight, then they record the revenue. They decrease the liability because they have provided you with the service at the time of the flight, and they record the revenue. So unearned revenue is something that you pay for in advance and you expect to get the product or good or service at a future date. This one sometimes gives students a little bit of trouble because of the word revenue. Students see revenue and they think, oh, it's revenue, but it's not exactly revenue. It's unearned revenue, which is a liability. It will eventually turn into revenue. But until you provide that product or service, it is just revenue. Some examples of long-term liabilities: notes payable, mortgage payable, and bonds payable. So often students will confuse accounts payable and notes payable. But remember, when there's really two distinguishing things. Accounts payable is typically going to be collected in 30 days or less. And it's not going to have interest. A notes payable is going to be longer term in nature, so at least more than 30 days and probably extending out more than a year. And it is going to bear interest. And then, of course, mortgage payable, that would be something like, we all have house mortgages, so a business might have a building that they have a mortgage on or land that they have a mortgage on, and that's going to be, 20, 30 years to be paid off. So that is definitely long-term in nature. And bonds are typically long-term in nature. They can be 5-year, 10-year, 20-year, 30-year bonds. Okay, now another thing that hangs students up a lot is that we have to consider the current portion of long-term debt. If you have a 10-year note or loan, 1 year of that is due in the current portion. The other 9 years are long-term, okay? So you have to think about that. If you have a 10-year loan, it's not all long-term. Part of it is due in this year, okay? So long-term payable, notes payable, they're typically reported in the long-term liabilities section of the balance sheet. But if the long-term debt is being paid in installments, if you are making payments, then the business is going to report the current portion, the portion that is due in that 1 year, that first year, or whatever year you're working at, the current year. That current portion is recorded in notes payable as a current liability. We just call it the current portion of long-term debt. So when you have long-term debt, you have to separate it into the current portion and the long-term portion. So whatever's not current, whatever's not due in the next 12 months, is classified as long-term debt. Also, sometimes businesses may know that they owe something, but they don't know the exact amount. That can happen. And so they have to estimate the amount of the liability, and they have to report it on the balance sheet. So this can be things like bonus plans, vacation pay, health and pension expense benefits, and warranties. Warranties to me is one of the easier ones to understand because, we all have bought products that have warranties. When that company provides a warranty, they really don't know how many people are going to, call up customer service and say, hey, my widget broke. I need you to fix it, right? So they can only guess. They can make an educated guess about what they owe for these warranties, but they know that some people are going to call, so they have to come up with some kind of estimate. Contingent liabilities. These are potential liabilities that depend on a future event. So a lot of times this is because of a lawsuit. Okay? So for a contingent liability to be paid, some event must happen in the future, or the business loses the lawsuit. Okay? It's not all lawsuits, but lawsuits is a really good example. And so how they record those contingent liabilities is based on the likelihood of events that occur in the future. And so we classify those as either remote, reasonably possible, or probable. And so if your lawyers or your accountants and all the people that are involved get together and they say, well, this could happen, but we really don't think it's gonna. We're pretty sure that this is a frivolous lawsuit and the judge is going to rule in our favor. Then we would call that remote. And if it's a remote contingent liability, we don't have to disclose it. You don't have to say anything about it. just ignore it, okay, like it's not going to happen, because it's, it's a remote possibility, okay? It's more than likely not going to happen. If it's reasonably possible, okay, if the powers that are involved get together and they talk about it and they say, well, there's a 50-50 chance it could go either way, and there's some precedent that shows that it may not go in our favor, so it's reasonably possible or probable, then you will disclose it in the notes of the financial statements. Okay, just in the notes you have to say, there's a lawsuit, blah, 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 and give a little information, describe it. Then if it's probable and the amount cannot be estimated, then you will disclose it in the notes of the financial statement. And you'll describe it as well. You will say that it's probable, but the amounts cannot be estimated. You'll give whatever information that you can because you're trying to keep your shareholders informed. And then if it's probable and the amount can be estimated, then you're going to record an expense and a liability, and you're going to base that on the estimated amount. So it becomes part of the actual financial statements and not in the notes, but actually recorded as an expense and a liability, and you use your best judgment. All right, so that's a pretty good overview of liabilities. Hope you enjoy this week, and I will see you in the discussion.